Now that we just finished the straight line depreciation with gain and losses as well, I now want to put it together with everything we did in the first video, which also includes the total purchase price of an asset and a possible capital expenditure later on throughout the asset's life. So that's what this first page of number 33 is going to look at, putting all of this together. And what I want us to do is anytime that there's a date over here, we need to provide the journal entry, whether it be a purchase or if it's at the end of the year, depreciation update, or at the very end when we have our sale of an asset with either a gain or a loss. Okay, so to start out, what you'll want to do as I go through each one of these, I'll kind of explain it, and then what you should do at that point is pause the video, attempt it on your own, see how you do, and then shortly thereafter I'm going to continue right in and show what the answers are. But if you just keep going and write down the answers, you're not really learning how to solve it, and by the time we come into class, you'll probably be lost. You've got to pause the videos and try it on your own. That's the only way to really get this stuff to really stick. All right, so the first part here, we need to we're going to be purchasing 2 computers, total price of $5,000. We had sales taxes that need to be included. And then also there was a delivery charge stated as FOB shipping point. We paid the entire bill in cash. And we're going to assume a 5-year useful life, $250 salvage value. So at this point, you need to do the purchase of the asset that I just bought. Tell me what you think the journal entry is for the end of the year. And then what's your updated book value? So at this point, pause the video, try it, and then here in just a couple seconds I will start to go through the answer. All right, for the answer, what I need to do is, even though the computers only cost $5,000 sale price, I actually need to add in the entire cost because the sales tax, that gets included. It was FOB shipping point, so that means me, the customer, has to pay any shipping costs. So I'm actually going to be charged, and I'm going to be paying $5,500 on July 1 of 2017. Now it's time for the depreciation part. The depreciation, well, this is my starting figure, so I'm going to take the $5,500. And then remember our new thing with a straight line, we got to subtract out the salvage value. So $5,500 minus the $250 salvage value divided by the useful life is $1,050. But then I have to remember that I bought this asset back in July. I only used it for half of a year. So instead of $1,050, I'm going to show as my journal entry depreciation expense for only $525, half of the $1,050. So if I were you and I was doing this one, I would have just on a little side, off to the side over here, and can have a continual updated T account for both the computers, your asset that you're buying, and your accumulated depreciation. So right now you have a debit for $5,500 in the computer asset account, and then the contra account right next to it, a credit balance of $525. If you combine these, we can now determine our book value. Our book value is simply the $5,500 minus the $525 for $49.75 book value. Okay, if you need to pause, please do. Otherwise, I'm moving on. For 2018, we're going to assume that nothing really out of the ordinary happened. We're just going to do a normal depreciation expense for my 2 computers. So pause for a second. Figure out what you're going to try to do. Put down your journal entry, update your T accounts, and determine what the new book value is. So for 2018, I already did the calculation. Since nothing new has happened, every year with straight line, I always use the same amount. So I can use the entire 1,050 because I had it for the entire year of 2018. So this journal entry is actually very easy. Simply do the depreciation expense again for 1,050. And then add this to my accumulated depreciation T account. So now I have the 525 from last year plus 1,050 added in. That now gives me a new book value, the upfront cost, $5,500, minus my updated accumulated depreciation. I've got a new book value of $39.25. Okay, so if you need to pause, go ahead and do that. And in 1 second here, we will move on to 2019, where we have purchased some new stuff. Okay, in 2019, we actually upgrade our computers. This would be a major item to a computer, like an engine for a car. And it also tells me it's going to be a major item because we're expecting with this new updates to add 1.5 years to my useful life. Now the cost for this new updates was $400. To put it in was another $300, and I paid everything in cash. In addition to having an extended useful life, I also have a new salvage value. The item's going to be hopefully worth more when I go to sell it. So what I want you to do is try to journalize my new purchase on January 1, 2019. Then you're going to have to recalculate your straight line depreciation because you have a new beginning number. And you also have a new useful life and a new salvage value to look at. With this one, you may want to walk through with me because this one does have some new things, especially when we get to the depreciation part. So that's what we're going to look at this time. So on January 1, I bought new software, total cost of $700. Since this is a major type of item, it's going to make my asset worth more, make it worth a longer life. I'm going to depreciate this, or I've got to put it as an asset so I can later depreciate it and not expense that cost up front. So notice here, I'm going to debit the actual account that I did way back up here. Whatever account you used in 7/1 of 2017, we're going to use the same account because I'm increasing the value of those computers. And I'm also going to then update my T account. So my computers are no longer worth $5,500, they're now worth $6,200. And now here in, I should say 2019, or yeah, 2019, in January 1, I've kind of got a new updated book value. This was my book value, but now I have the old cost plus my new stuff, so $6,200 minus my accumulated depreciation. So $6,200 minus what I have in accumulated depreciation gives me a new book value of $46.25. Now, to do the updated depreciation expense for 2019, I can't just go back and use the $6,200 number as my actual cost because I can't use that number because I've already depreciated some of that $6,200. So I have to actually use my new book value instead of the actual cost of $6,200 to update my depreciation expense. So again, that's where this number comes from. It's my $6,200 minus the value of the asset minus how much I've already depreciated because I don't want to depreciate that amount again twice. So I take that cost minus my book value. That's my starting point. And then subtract out my updated salvage value. Now we're just back to normal. Subtract out the 575. That's my new estimate. With an estimate, you can change those at any time and not affect prior years. I wouldn't have to go back. If you remember with the FIFO-LIFO, if you change from FIFO to LIFO, you actually have to go back and restate your books up to 2 years. So everything can be compared to prior years. This year's amounts need to be comparable to the past 2 years for the income statement. And they will not be if you change from FIFO to LIFO and then didn't go back and change your prior year books. So it takes a lot of work when you change the actual accounting principle, the principal change from FIFO to LIFO. In this case, our principal would change if we had new methods, like straight line to one of our new ones we're going to use, double declining, here in the next video. But simply changing a method or simply changing an estimate does not mean we have to go back and restate anything. Then you look over here at my useful life. This is what I had left of my useful life after I depreciated. Remember, I have that depreciation going on up here. After I depreciated, I have 3.5 years left. But this new item added 1.5 years to that, what was remaining. Oops. So now I can do my new depreciation expense formula. Get the total here and divide it by 5 for 5 years. And when you do that, you'll get $810 for my depreciation expense for the end of 2019. That then gives me a new book value, original cost, minus now my brand new accumulated depreciation. Leaves me a book value of $38.15. Okay, pause if you need to. I'm going to move to the final part of this one where we actually get ready to sell the computers in Part D. And in July 1, 2020, so the next year, I actually sell the 2 computers and I sell them for $4,000 cash. Now remember, there are 2 things that we have to do when we sell something. We need to update our depreciation to show that I used the asset for those past 6 months from January through June. And then actually on the date of sale, I need to show that I got rid of the equipment and brought in cash. Okay, so now in 2020, nothing new happened, meaning any new purchases. So I can still use my most recent straight line depreciation amount. And if nothing happened for the next 5 years, I could use $810 for the next 5 years, or 4 years now, $810. However, since I only had the asset for half of the year in 2020, I can only use half of this. So that's where I get $405, half of the $810. I want to update my T account for the accumulated depreciation because it's now time to do the actual sale. The sell price, I'm going to debit my cash. That's what I brought in. And then I need to show that I'm getting rid of stuff. I'm getting rid of the computers. Remember, the computers have a cost on my books of $6,200. So I'm going to need to credit my computer account for that $6,200. I'm going to need to credit my accumulated depreciation for not just $2,385, but $2,385 plus my brand new $405 added into it. So that gives me $2,790. Need to get rid of that account. Get rid of my computers. At this point, I have $6,790 in debits compared to $6,200 in credits. I could do my little formula at this point as well. I could say I got $4,000. I had a book value of $62 minus the $2,790, whatever that comes out to be. It'll be somewhere around $37 $34.10, I think. In that case, I got more $4,000 than what it was worth on my books, $34.10. The remaining difference is our gain. And remember, gains are very similar to revenues. They're always a credit. Gains are always a credit. Now, if we add up our two credits, I will have $67.90, which is what my debits equal. Now, what I wanted to practice with for number 2 here, and this is just basically one problem done 3 different times, is I want you to take now, pause the video after I explain it here, and with this opening information, this is what my books were as of, this should say as of 20, well, it can be 2017. This is what my books say. On 2017, these were my up-to-date balances. So I had the equipment who knows how long. It doesn't really matter. As long as I have this up-to-date balance and I sell it at the beginning of the year, since I'm selling it basically the very first day of the year, there's nothing for me to depreciate. I haven't used the equipment yet this year. So what I want us to do in this case for A, B, and C is just practicing how to sell the equipment, what our journal entries would be, and if it would be a gain or a loss. So at this point, you should pause the video and attempt to do A, B, and C. And then here in just a couple seconds, I will go through the answers. Okay, when you are looking at this, one way to determine real quick, and you can make a little jot off to the side before even doing your journal entries, is if there's a gain or a loss on each of the sale prices. So I can look at this, and I can see that it has a book value of $7,000. If I brought in 11, so more than the book value, over here I could jot in that there's going to be a gain of $4,000, 11 minus the 7. Over here, so we still have 7,000 book value, but if I only brought in 2,000, 2 minus the 7, that's going to be ended up being a negative number. I'm going to show over here off to the side temporarily that I have a loss of 5,000. And here, if I didn't get anything for it, 0 minus 7,000, I'm going to have a loss of 7,000. Now I can go right in and do the journal entry. So let's look at Part A first. What did I get? It says I sold it for 11,000, so I'm going to debit my cash for 11,000. I need to get rid of my accumulated depreciation and my equipment. Currently, this has a credit balance on my T accounts. So if it has a credit balance, I want to debit that amount. The equipment has a debit balance, so I want to get rid of it, credit the 20,000. Right now, my debits do equal 24,000. Credits equal 20. So the difference, as I had off to the side, number 2A is going to be a gain of $4,000. If you need to, pause and fix B and C. For B, really one of the only things that changes up front is the cash T account still stays the same, or the cash account still stays the same. It's just now instead of 11, we're only bringing in 2,000. We're still going to get rid of the accumulated depreciation. That doesn't change. I'm still getting rid of the equipment. My credit's not going to change. So my credit's still 20, while my debits right now are only 15. So therefore, I'm going to have a loss this time of 5,000. Just what I had in my little notes as well over here. I had a little loss for $5,000, and yep, I can verify that. Now my debits do equal my single credit here of 20,000. For Part C, we ask when we throw it away, what do we get? And the answer is nothing. We get nothing. So cash, you could journalize that as 0, but that's kind of silly to do. And then my credit, well, how did I get nothing? Well, I got rid of my equipment. So this is going to be the same. I got rid of it. I'm still going to debit that one. I'm still going to credit the 20,000. It's now, I have 13 in my debit column, 20 in my credit, I'm going to now have a loss instead of 5. I'm going to have a loss of $7,000. Okay, that will conclude the first part of the exercises for this video. In the third and final video, I will do the double declining in units of production along with numbers 3 and 4 in this exercise. We will combine them into one for the final video.